Hi friends, welcome to the most important paper for December 2025. Only now 4 or 5 hours are remaining, right? For the paper first batch, right? So follow it completely. It will be hardly for 1.5 hours. Follow it completely. Most important theory and numericals will be taken over here. Okay? So follow completely. Got it? Don't miss this. In the Treasury, VAR is used for which of the following purpose? Firstly, what is VAR? VAR is value at risk. Okay, VAR means value at risk. This means, I'll write it over here, value at risk. Okay, that is VAR. It is mainly used in your market risk. Okay, so VAR is used for the following purpose. Statement 1. To calculate the potential loss while holding the trading position in the foreign currency and securities. Calculate the potential loss. Okay. For this foreign currency and securities. See this market risk. I told you. So market risk is the main risk in banking, which you cannot count, which is not in your hands, which you can't control. Okay. Statement 2. It is used for long-term risk management. So where is it used? Is it used for long-term or is it used for short-term? So which one is true? To calculate the potential loss while holding the trading position in foreign currency and securities. To calculate the potential loss. Okay. So statement 1 is true. Obviously statement 1 is true. So 1 is true. What about second one? It is used for long-term risk management. Is it used for long-term risk management? VAR is never used. See, theoretically, if you say, somebody can debate on this. Yes, why can't we use? We can use VAR for long-term also. Okay? We can use it for 1 year, more than 1 year. I can use it for 10 years also. I can use it for 50 years also. You can use it. Theoretically, you can use it. Nobody is saying no. But the question is it used? Practically, is it viable? Long-term VAR calculations will not give you the exact answer. Okay? They will not give you. It is always used for short-term, within 1 year. Okay? Check all your VAR calculations. Generally, they are within 1 year. Can't they give for 5 years? They can give, but they are not giving. Why? The reason is VAR is not at all that much useful if you go for a longer term, 10 years, 15 years. Okay. So, statement 1 is true. 1 only. Okay, 1 only. Statement 2, some of the books might be saying, okay, right, some of the teachers might. It is, see, theoretically you can do it, but practically it's not possible. In Treasury, it's not done. Okay. See, VAR is of 3 types. Look at this. Historical VAR, I have given it over here in short, in smaller. See, VAR over here is of 3 types. One is historical VAR, parametric VAR, and Monte Carlo VAR. There are 3 types of VARs. Kindly note. Historical VAR is given by -1 into percentile loss into portfolio value. Parametric VAR is given by -1 into Z-score into standard deviation into portfolio. And Monte Carlo is given by -1 into percentile loss into portfolio value. These are the 3, at least the names you remember. Okay? Historical, parametric, and Monte Carlo. These are the 3 types of VARs. Got it? So, let's move on. Which of the following statements about credit risk spread are correct? Always check what is asked in the exam. Are they asking you correct or are they asking you wrong? The pricing of credit is done on cost plus approach, that is benchmark rate plus spread. The spread comprises various factors that includes product specific operating costs, credit risk premium, etc. Business strategy is a component of spread under MCLR. MCLR system. And last one, the spread components can be negative in MCLR. So which one are correct? The spread components can be negative in MCLR. Yeah. So which is the true one? See the options also 1, 2, 3, 4. Only 1, 2, 3, 2, 3 and 4 and 2 and 3. So what all can be done over here? The pricing of the credit is done on a cost plus approach. Cost plus means basically your benchmark plus the spread. Cost means what? Whatever is the benchmark. Okay. For internal it is MCLR, for external it is repo. For Forex it is nowadays ARR. Okay. So these are the benchmarks. That benchmark plus spread. So that is cost plus. So this is true. One is true. What about the second one? The spread comprises various factors that include product specific operating cost and credit risk premium. So that is also true. Right? Because the spread means what? The difference. Benchmark plus 2%. So it's like this. Repo plus 2. Repo plus 2. So this 2 is known as spread. This is the spread. Okay? Spread. Got it? So this 2 comes how? It is all your calculations. Your NII, what is the interest? Okay? Interest difference between the loans and the deposits. What are your expenses, operating expenses? All these. So this is also true. Business strategy is a component of spread under MCLR. Business strategy is a component of spread under MCLR. So what do you mean by business strategy? Business strategy means model, your business model. Your business model should be such that you must get some profit. Okay? So that's a part of MCLR. What are the 4 parts of MCLR? MNOP. Okay? Marginal cost, negative carry, operating expenses and tenor premium. 4 parts are there in MCLR. Kindly note this. MCLR has 4 components. MNOP, simple. OP, okay? Marginal cost of lending rates, okay? Marginal cost of lending. N is negative carry, for CRR, it's specifically for CRR, okay? O is operating expenses. Operating means your salary is etc. Salary, electricity bill, all these expenses. And P is tenor premium, longer term loans, tenor premium. These are for the longer term loans. Kindly note, tenor premium is always for the longer term loans. So these are the 4 components of MCLR. So business strategy is a component of spread under MCLR. So what is the spread? This marginal cost. This is a spread. So this is also true. What about the 4th one? The spread components can be negative in MCLR. So spread components can be negative. Which one can be negative? This will always be positive. Tenor premium. This will always be positive if you are having a long-term loan. Negative carry for CRR. It can never be negative. Negative carry for CRR. The spread components can be negative in MCLR. Yeah. Negative carry for no, it will also be positive. Negative carry for CRR means what? What is the opportunity cost which I am losing because of CRR? Do you know what I mean by this? Opportunity cost means basically, suppose if I am giving money to RBI for CRR, okay? I have to give it in cash, okay, or I have to credit it into that account. I don't get any money for this. I don't get any interest for this. Now, instead of putting this money in CRR, I would have given it as a loan. I would have got some interest. So that is known as negative carry. That negative interest loss is known as a negative carry. So that will always be positive. You can't have a negative CRR. Okay? Negative carry over here. And marginal cost, your loan rate will always be higher than your deposit rate. So this will also be positive. So this answer is false. So the answer will be only 1, 2 and 3. Answer will be only 1, 2 and 3. Got it? Clear? Read this. Again read this. Everyone. Read it. Read this, very important one. Very important question this is. Okay? Clear? Read it, read it. It will take some time, but read this because this is a very important question. Got it? Done. Pause this video and then read it. Okay? Move on. Which of the following statements regarding the treasury are true? Again, you want true only. Huh? Statement 1. Treasury operates in interbank markets which are free from credit risk. Interbank market which are free from credit risk. Free from credit risk. Statement 2. Treasury is highly leveraged as the risk capital allocated is just 2 to 5% of the transaction size. Statement 3. Operational cost of treasury is very high. So which one of them is true? So you want it true, huh? Which one are true? Think over it. See, treasury operates in interbank markets which are free from credit risk. Is it true or false? Credit risk means the seller of the bond will never fail. Or if he fails, then somebody takes the risk of this. So it is true. It is true. Why? Because here, kindly note for statement 1, I'll give you the reason. Statement 1. Okay, I'll give you the reason. The credit risk part over here is covered by CCIL. CCIL gives you the guarantee because it is the operator in between. It is the agent, you can call it. Or it is a clearing agent, you can call it. So it takes the responsibility. CCIL takes the responsibility, Clearing Corporation of India. So this is true. Statement 1 is true. Okay. What about statement 2? Treasury is highly leveraged as capital allocated is 2 to 5%. This is the most correct statement. Treasury has a high leverage. You can take just 2 lakh or 2 crore rupees and do the trading of 100 crores. 2 crore to 100 crores. That much trading you can do. So it's a huge leverage business. But because of this leverage, what happens? You can earn profits. But there's also a problem. If you suffer a loss, you lose a lot. You will have to sell certain important assets of yours if you make a loss. Okay? So this is also true. Third one, operational cost is very high. That is false. Operational cost in treasury is always less. Why? Because there are very few employees. Full treasury is generally managed by hardly 5-6 employees. For big banks also. Okay? Some banks have this, let's say 15-20. But main are only 3-4 in any bank. Okay? So statement 1 and 2 are true. Okay? Third is not true. Statement 1 and statement 2. These are true. Treasury in foreign exchange product may enter into a spot trade where the settlement of funds is done on dash day. Now this is important. Spot. What do you mean by spot? What do you mean by spot? So now you need to understand certain elements. What is it? One is cash. Cash, or we call it ready. Anything. Cash or ready. So settlement is done on the same day. Same day. Okay, I'll write day over here. Otherwise, I'll have to write the day. So same. Okay. Same. Suppose if I am doing it for Tom, then it is next working day. Okay, next working day. Next. Always remember the day is known as working. Working, not calendar day. Whenever I'll work, whenever I'm open for working, normal business, then it's called as working day. Then you have a spot. Spot is what? Second working day. Second. Second means next to next. perso, we call it, right? And then last one is your forward. That is any day after spot. Any day after spot. Okay? Any day after spot. So this is the meaning of all these: cash, term, the spot and forward. One more is there, future, but future and forward are same. Future is only organized forward, by remaining logic is same for future and forward. So what is this now? The fund settlement is done on the first day, second day, third day, fourth day. See, this first day is cash, second day is term, third day is this, and fourth day will be forward. So the answer is this, third day. Okay, the settlement is done on the third day. Got it? Which of the following institutions is the nodal agency of the government of India to manage export marketing fund, EMF? Now this EMF fund is given by World Bank. Okay, there are three types of EMFs: EMF 1, 2 and 3. EMF 1 is for manufacturing, specifically for manufacturing. Okay, it is given by World Bank. EMF 2 is for setting up the offices, and EMF 3 is from our own Exim Bank. First two are given by the World Bank, and EMF 3 is done by the Exim Bank itself. But who manages all these three funds? RBI, Exim Bank, Ministry of Finance, Ministry of External Affairs. Who manages? Think. Everyone think over it. Give me the answer. Who will manage this? It is Exim Bank. Exim Bank manages all these. Got it? Exim Bank will manage all these. Clear? Under which method of value at risk calculation, VAR is calculated using a sample of randomly generated price scenarios. Randomly generated. So, correlation method, historical simulation method, Monte Carlo simulation method and backtesting. Think of it. Under which method we do it? By randomly generated scenarios. Randomly generated means what? What is randomly generated? These are hypothetical. Okay, hypothetical. See, I'll explain you certain terms over here. Okay, first let's go one by one. Correlation method. Correlation method is used for only two elements. Whenever you want to compare two elements only two elements, kindly note. Two elements. You have this in your ABM also, correlation and regression chapter. So there also you compare only two elements in correlation. Historical simulation. Historical simulation means history. I'll go back. See, historical simulation and backtesting, they are similar. Why? Because backtesting also does what? It checks the history. And based on the history, it will give the results. Okay. Simulation means what? This historical simulation means backtesting plus the various scenarios added to it. But these are all based on history. So these two are same. Only what is correct over here is Monte Carlo. Monte Carlo is the right answer. Why? Because Monte Carlo simulation thinks of or propagates or it follows hypothetical situations. Hypothetical means what? Whatever has not happened up till now. Theoretical. Whatever has not happened up till now, if that happens, then what? Whatever has not happened up till now, if that happens, then what? Like COVID. In 2019, did anyone think that such a situation will happen in the world? That the whole world will stop for 2 years. Whole world. Nobody thought. Means if I would have said at that time that in 2020-21 the whole world will come to halt, you'll say, hey, nothing happens. But what happened? Actually 2021 world came to a stop, right? So that was it. That's a point. Okay? So hypothetical, this is all hypothetical situation which has not happened up till now, can happen in future. Okay, so the right answer is Monte Carlo. So this is the right answer, hypothetical. Okay, kindly remember These are all simulation and stress testing. This is a part of stress testing. Stress testing is always hypothetical. We always check those parts which are not there, which have not happened. Back testing is historical. Okay. So here the stress testing word is not mentioned, but this is a part of stress testing. Okay. Stress and back, these are the two testing methods. Mainly they are used for your market risk in Basel. Which among the following is correct as per Basel III? Which among the following is correct as per Basel III? Total risk-weighted asset equals to risk-weighted asset for credit risk plus 12.5 into capital risk required for market risk plus 12.5 into capital risk required for operational risk. B. Total risk-weighted asset equals to same. First is same. No, changed. RWA for market risk plus 12.5 into capital requirement for credit plus 12.5 into capital requirement for operational risk. Total RWA C now. Total RWA equals to risk-weighted asset for credit risk plus 12.5 into capital requirement for credit risk. See, both are credit over here. Plus 12.5 into capital requirement for market risk. Third, total risk-weighted asset equals to risk-weighted asset for credit risk plus 12.5 into capital requirement for market risk plus 12.5 into capital requirement for credit risk. So, which one is true? C and D are similar ones, isn't it? Only here they have interchanged. Obviously, C and D are not the answers. See, very frankly, C and D are not the answers. The answer is between A and B. Risk-weighted asset for credit risk plus 12.5 into capital requirement for market risk plus 12.5 into this operations risk. Similarly, over here, market, credit and ops. Answer is between these two only, A and B. So now, which one is correct over here? So the answer as per the Basel, see, it's given as per the Basel. As per the Basel, this is the correct answer, A. Always remember, RWA for credit risk will be given to you in exam. Credit risk will be given to you in exam. Because that is easy to calculate, that's why it is a standard one. Capital risk for market risk, capital requirement. So RWA for market risk is never known. That you will have to calculate. Similarly for ops risk, you will have to calculate. So as per Basel, this is very correct. Many of you learn this formula, isn't it? But I'll tell you what is the reason, logic behind this formula. Why this 12.5? Why not 13.5? Why not 11.5? 12.5 means if you divide, see what is the basic CRAR requirement as per Basel without buffer, CCB buffer. In the comment section, everyone. What is the CRAR requirement as per Basel III without CCB? It is 8%, isn't it? Right? Comment section, everyone is typing. Let me see. 8%. Right? So it is 8%. So just divide 100 by 8. 100 by 8 divided. What will you get? Let's see. 12 8s are 96. And there's 4 remaining, half. So 12.5. Right? So 8, 12.5 is 100. So from there you get this 12.5. 100 divided by 8. 100 divided by 8 equals to 12.5. You get this. But now there's a catch over here. What is the catch? See, we are covering theory also. That's why. Otherwise, I'll just take the answer and move ahead. We have to cover the theory also, so that you need to understand the concept. Why this? So the point over here is, if you check as per RBI norms, this 12.5 will be wrong. Why? Because as per RBI norms, you have to divide this by not 8, you have to divide this by 9 without buffer. Without buffer, you have to divide it by 9. So 100 upon 9 it is. So it will be different. 9 11s are 99. 11 point something it will be. It won't be 12.5 as per RBI. But RBI even says, see, even Basel III says, you have to add the CCB. Even RBI has made it compulsory. So actually, your CRAR requirement is not 9% now. It is 11.5%, 9 plus 2, 2.5. So this CCB of 2.5% has to be added. Kindly note, there are two buffers as per Basel III. One is capital conservation buffer, that is 2.5, that is to be compulsorily added. So 9 plus 2.5%. Plus, there is a second one, counter-cyclical capital conservation buffer, CCCB. So that has to be added, CCCB has to be added by RBI. Bank doesn't add it. RBI will put it to the banks that, see, from next year, see, 4 quarters it has to give the, RBI has to give the notice to you as a bank. All this is there in your BFM. All this, every part, whatever I am speaking is there in your book, in your BFM. I take the same in the paid classes. Join them myself. Wherever possible, join it. Okay? So now, actually as per RBI, you should divide this by 9 or even 11.5 now, not even 9. You should divide it by 11.5. Okay? Because that is a new CRAR. So, if it comes the question of Basel, then it is 8. That is 12.5. 12.5 is correct. Okay? Next one. Read this. This is a bit difficult numerical. A bit difficult. Treasury is planning to invest in a scheme in which it has to deposit 18,250 now, for which in return the Treasury would receive rupees 5,000 at the year end for the next 5 years. For the next 5 years. Advise the Treasury officer concerning the investment. it becomes NPA, you can call it NPA, it becomes overdue. So in that case, convert this Forex to INR, rupee liability, and this process is called as crystallization. Okay, this process is called as crystallization. This is always done for the NPA loans, NPA Forex loans. Okay, NPA Forex loans, that's known as converting the Forex liability to INR. Okay. Now, what is this numerical? See, an exporter had an export bill of USD 10,000 discounted by the bank. So, discounted by the bank means what? Bank had given the finance. This was financed. This was financed by the bank. Okay. So, export bill of USD 10,000. Export means he had done some export few years back. Okay. A few months back, not years back. Few days back you can call it. It's given. Everything is given over here. Few days back he had done some export. And now this export was due for payment. It was due for payment. It was to be paid. But look at it. He had done an export. He had taken the finance from the bank. And now what? The due date for realization has passed. Now the payment was to be received, but it has not come. Okay, means the payment from the buyer has not come now. This should have been received by the bank, because what will bank do? Bank has given you the finance, customer, and now it has to get the money from the buyer in dollar on the due date, but it has not got it. And the bill is now overdue. So this is overdue now. Okay, the bill is overdue now. Now what is given? INR interest rate is given as 7.5%. INR interest rate is 7.5%. Penal interest rate is 9.5%. This is the rate of interest. For rupee loan is 7.5, and for this penal interest it is 9.5%. Now what are the details? Due date of that bill was 15th July. Okay, due date of the bill was 15th July. So on 15th July the buyer was to pay. 15th July the buyer was to pay. Okay. Date of crystallization is 5th August. So on 15th July the buyer was to pay. It has not paid. Buyer has not paid. So bank has to convert it to the rupee liability. So bank has converted it on 5th of August. Original bill buying rate is USD 1 INR, 1 USD equals to INR 80 on 1st July. So original bill buying rate on 1st July. It means, what do you mean by this 1st July date? Original bill buying rate on 1st July means the bill was financed on 1st July. At that time bank had bought. So bank had financed on 1st July. TT selling rate on 5th August. See, 5th August is which date? Crystallization. 5th August is INR equal USD 1 USD equals to INR 82. Okay. So the exporter will be liable to pay what amount? What is the amount the exporter should pay to the bank? Problem is not simple. Firstly, have you understood the crystallization? Type yes in the comment section. If you have understood the concept of crystallization, Forex liability to INR liability. Now I'll go further. How to convert this? What is the rate to be taken? Whenever you are converting any Forex liability to INR liability, the rate to be taken is number 1, higher of. See this, higher of original bill buying rate. So original buying rate, I'll write it, bill buying rate. Okay, or should I write it full? I'll write it full only here because it gets confused, these short forms. Bill buy and original bill buy. On which date? 1st July, when it was purchased. So original bill buy or second is TT rate. TT selling date means on the crystallization date. TT selling on crystallization date, crystal date. So higher of these two, you have to take higher of these two. Okay, you have to take the higher of these two. Pay attention, very, very, very important terms. Okay, crystallization is always to be done when the liability, the payment is not made on the due date. At that time the crystallization is to be done. There are rules for this. Okay, there are rules for this. RBI has given certain conditions. Those we'll discuss someday later. The crystallization rules for import bills are separate. Crystallization bills for export bill are separate. Crystallization rules for usance bill are separate. Crystallization rules for side bills are separate as per RBI. Those I'll discuss someday later in a single video, because that requires a separate video. That is not, it can't be covered in any other videos. Okay, I'll do it separately, that session. Let's try tomorrow only. If tomorrow I can, means next any days. Okay, so next. So higher of original bill buying or TT selling, whichever is higher. Okay. Now check this, which is higher, 80 and 82. So this is higher. So I'll be using the rate of 82 over here. Higher of original bill buying or TT selling. So I'll be using the rate of 82 over here. So now what is to be done but? What is the rate? What are the days? Rate is done. What about the days? See, the bill was purchased on 1st July, 01 July. The bill was purchased, means bank and financed. When was the due date? 15th, I think so. 15th July. Due date. Due. Okay. So this was finance. Finance was done on 1st July. 15th July was the due date, isn't it? 15th July. Where is it? Yeah, due date was 15th July. Crystallization is 5th of August, means payment is not received on 15th July. So here payment was to be received, but no, not received, payment not received. So now it is extending. And on 5th August, ultimately bank said that nothing doing. Now convert this. So here crystallization is done. Crystallization. So I have converted the entire liability to INR. I have converted the entire liability to INR. So now, what will I apply and what will the exporter pay me? See, what was the amount of the bill? 10,000. $10,000. Rate I have fixed now. Rate is 82. So I have to convert it at the rate of 82 now. Okay, forget all the rates now. 82. Now interest up to due date. Up to due date, you should always charge the normal rate of interest. What is the INR rate of interest that you should charge? Okay. So what will you charge? Normal rate of interest, INR. What is the INR rate of interest? 7.5%. So you will be charging here 7.5%. 7.5%. And for this remaining part, you will be charging 9.5% penal, isn't it? For this part, you will be charging 9.5 penal. Got it? Clear? This should be very clear in your concept, in your mind. Where do you charge regular? Where do you charge penal? Now calculate the number of days. Calculate the number of days. 1st July to 15th July. Okay, 15th July end. Due date, full date. So what is the number of days? 15 to 1st. So it is 15 days. 15 days. And here 5th August to 15th means 15 July to 5th August. So it is 25 and 5. July is of which, how many days? January, February, March, April, May, June, July. 31 days. So 31 days. So this will be 21 days, not 20 days. 31 days, 21 days. Why? Because July is of 31 days. Okay. So 21 days over here and 15 days over here. So what should that customer pay me now? That customer should pay me, see this, the exporter. Exporter will pay what? Exporter pays, what does he pay? First, principal is main, right? Principal plus normal interest plus penal interest, right? These three things the customer will pay me, and if there are any charges, extra penal, any charges which I am charging, charges. But here no charges are given. In this numerical, if you see, there is no charge mentioned. Otherwise, they mentioned it in the numerical. Kindly charge this, as this fee, that fee, any fee. So charges. But here there are no charges. So this will be 0. Okay. Now calculate these three. Principal. What is the principal amount? P equals to, what is the amount? $10,000 into rate we have fixed just now, 82. So 82,000 rupees, 82,000 the customer will be paying me. 82,000, this is my principal amount. The customer will be paying me 82,000 as a principal amount. Now regular interest equals to normal interest. NI, I'll write it, normal interest. 82,000, see this principal what he has to pay, because after all I have financed him 82,000 INR. 82,000 into 7.5% into, nowadays this 7.5% is for 1 year. Pay attention. This 7.5% is per annum. This is per annum, PA. But am I charging him for per annum? No, I am charging him for only 15 days. So into 15 upon 365. 15 upon 365. This is what you need to understand. Calculation of simple interest. So, what are you getting? Try it everyone on the calci. Don't try it orally. Try it on the calci. So, 82,000. I'll also try it. 82,000 because I also don't have the answer. 82,000 into 7.5%. So see this 7.5% means 7.5 divided by 100. Divided by 100. You can mark this percent, you can remove it and mark this 100 over here. Remove this percentage. Okay, remove this percentage over here. Okay, so 7.5 upon 100. Got it? So into 7.5 into 15. Immediately first do all the numerator. 82,000 into 7.5 into 15 divided by, now do this, divided by 365 and 2 zeros, right? So you are getting it 252 rupees, 252 rupees, 253 you can take it, 252.7 it is. So 253, okay? Now what about the penal? Penal interest is penal, PI. So that is equal to again the same amount, 82,000. 82,000 into 9.5, right? 9.5 upon 100 into 21 days now, 21 upon 365. Try this. 82,000 into 9.5 upon 100, because 9.5 is the penal interest, into 21 upon 365. Do it everyone. So 82,000 into, what is this, 9.5 into 21 divided by 365 and double zero. So the answer is 448. Are you getting this? 448, everyone? 448 point something. So leave that point. What is your final answer then? What should the customer pay me as a bank? I am the bank. Customer is the exporter. So what should the customer pay me? So customer should pay you now. Customer pays or exporter pays. Okay? Pays what? Total of all these. 82,000 plus, what is this? 253 plus this last one. What are you getting? Some mistake. Okay, 82,000 plus 253 plus 448. What are you getting the answer? How much the customer should pay you? 82,701. 82,701. This much the customer will pay you on crystallization. This much the customer will pay you on crystallization. Okay? This is an important numerical for crystallization. This is an important numerical for crystallization. Crystallization is an important topic in exam. Every time it is asked, every exam of BFM, crystallization of exports will be asked to you. In this case study, if it comes, will be for 5 marks. Various elements will be asked over here. See, 1 mark for this, 1 mark for this, 1 for this. So 3 marks over here. Plus some this charges will be given to you. Something they will adjust it and make it 5 marks. But you have to understand the basic. What is the basic? The rate of interest to be applied is either, see, this part is very important, higher of original bill buying rate or TT selling rate on the crystallization date. Higher of bill buying rate when I purchase the rate, purchase the bill, and whenever I am selling the bill, higher of these two. See, we are in business. Banking is a business. I can do the loss over here, right? Because customer has made an error. Who was to pay on the due date? Was I to pay on the due date? No, customer was to pay. His buyer was to pay. So buyer has not paid. Means whose mistake is it? Buyer has made the mistake. And if the rate, say this, suppose I'll tell you one hypothetical case. If this rate over here was, let's say, 70 rupees. If this rate was 70 rupees, then what rate will the bank apply? Will bank apply 5th August rate, that is 70 rupees? No, it had purchased at 80 rupees. I had purchased something at 80 rupees and now the rate is 70 rupees. So will I sell at 70 rupees? No. What will I do? My purchase price, higher of these two. Whatever is my present rate and whatever was my original rate. After all, this is the same logic of normal business. You will always sell anything for higher than the rate which you had purchased, right? Or at least for the rate which you had purchased. Suppose if you buy a flat tomorrow and afterwards the rate of the flat goes down. So will you sell that flat at a lower rate? No. What do? You keep that flat. Let the original rate come. And then no profit, no loss, you can sell it. So it's always higher of either the original bill buying rate or TT selling rate on the crystallization date, whichever is higher. This is the crux of the numerical. Most important part of the numerical is this.